So it's great to have everybody on a Saturday. I can see that there are people, quite a few people who have just landed in Dubai and turned up here. So you'll move the slides, right? Yeah. From Singapore, there are people coming in from Abu Dhabi. From Chandigarh. Yeah. So it's really great to have everyone here and to take out your Saturday morning. And I can absolutely assure you that it's more important for you that you attend today than for us because the takeaways are going to be amazing. We've seen a lot of founders through our programs. They build, they continue to build, but they struggle to articulate. They all get into fundraising, hit hurdles. So I think this story is very important for founders to take away and have the conversations that you need to have within your team, externally, when fundraising, etc. So I'll share a little bit about TiE Dubai. TiE Dubai is part of TiE, a global organization, a conversation that started in Silicon Valley more than 30 years back. And we've been here in the Middle East more than, I think we are almost hitting our 25th year. So we've been talking entrepreneurship before the media could actually spell it without a spelling mistake. We had to spell it out. It's not a joke. So we actually had to spell out entrepreneur as a word for the media. So we've been here, heart of the community. We work very closely with multiple accelerators, incubators, funds, and channel founders through our programs to have access to all of those various things. So I can see a couple of founders from our programs here, but I think there should be more. There are a few who are on their fundraising journey who haven't come. And how TiE functions is really for the community. You can follow us on Instagram, LinkedIn, YouTube. YouTube, we publish all our events post the event. And in Instagram and LinkedIn is where you get to know about our upcoming events. We do this regularly, different topics that are value for founders. And we would want you to, encourage people to come, learn, because that sometimes it's what you don't need to do. You don't need to make the mistake somebody else has made, right? So that one line could actually transform what you take away from here. And charter members are what forms the backbone of TiE as an organization. They're global, they're successful entrepreneurs, they are mentors who give back their valuable time. They form the board, they run the programs, and I think they're phenomenal people because they are really, their core desire is to build the ecosystem and really help with the next generation. So that's a little bit. So we have 5 pillars that we work with: mentoring, networking, education, funding, and incubation. So under those, we sort of work through various paths for the journey of the founder. We have a TiE U. So we run a program for the university students where we take ideas stage, mentor them. I'm very happy to say, has Vamsi come in? Our runner-up from 3 years back, he was an idea back then. We got him into the program, we mentored him, and he's done his fundraising. He's doing very well, continuing to build. He's only 24, 25. So Monday has pitches from UAE and Emirati region. The Middle East Africa will be an online segment later. But if any of you resonate with the program and you want to be able to hear founders with ideas from these various universities, please plan to join us. We also working with Dubai Holding to actually encourage founders who are working on a startup that has a sustainable impact. It could be any sector, but it could even be AI, right? Using AI I know some people use it for cultural impact. We heard some founders at the last open pitch night. So make sure you apply or encourage founders in your circle to apply. It's an absolutely brilliant program. And you get to pilot with Dubai Holding if selected. So you go through a 12-week accelerator program and then get to be a part of it. So apply. And then if you want to stay up to date for what's happening in TiE Dubai, please join our WhatsApp community and chat. We're not very chatty yet, but we welcome you to join and chat. I'm very pleased to hear there's many industries, founders, lawyers in the audience, and I want to get into today's session before I take any more time. I want to introduce Anirudh. He's the founder of Loco, a leading global live streaming platform backed by investors including Sequoia Capital, Crafton, Makers Fund, and how do I say that? 314? Yeah, 314. 314 Capital. Loco was recently acquired by UAE-based Redwood, making his second major exit after Pocket Aces, India's top digital entertainment company, which he co-founded and led it to its 2023 acquisition by Saregama. So I think even the time gap is really exciting to hear. He helped make gaming mainstream in India, build large communities, and partnering with major publishers and brands. Anirudh has been featured twice on Fortune's 40 Under 40 list and holds degrees from UI, UC, and Wharton. And he just got his driving license.
And he stopped driving.
Yeah. Deepak. So I don't know if I'm doing justice in introducing him, as in, I think he's a very humble man who has literally created a lot of things in Dubai. But I'm going to go per his intro, please. He's an amazing mentor. He's an angel investor, active. He's on the board of Angel Spark. So do connect with him, founders, and a very generous soul when he's mentoring as well. So do take that effort. He's currently partnered at 10100, a strategic foresight advisory that seeks to unearth and explore the eye-opening possibilities that the world could have in store for us in the coming decades. All the AI people, I met quite a few. He's also interested in angel investing in early stage startups, in tech, innovation, particularly in real estate and financial services. He sits on 3 boards publicly traded in Europe. He was the founder and CEO of EIT, Emirates International Telecommunications, an investment company in the TMT sector across the Middle East, North Africa. EIT is a fully owned subsidiary of Dubai Holding. EIT was specifically formed to build a telco portfolio for Dubai Holding. So that's in a nutshell about Deepak. And we're going to keep it interactive. That's the plan. So we would encourage you to have questions as we go, because what we want all of us to do is learn together. And one ask is if we can use the mic, because when it's being recorded, we publish this. So whoever is watching can actually find value when you hear it through the mic. Otherwise, they can't hear it. Thank you. Deepak,
Thank you,
Anirudh.
Thank you.
Good morning, everybody. This is an experiment we are carrying out. This is the first time we're having a Saturday morning session to avoid the traffic jams which we normally have on. But that apart, this is being recorded. This is on YouTube. Depending on the topic, we promote it on YouTube as well. So a lot of people will be watching it. So we gave up a warning to Anirudh so that he doesn't mention names. So that apart, this is a really proud moment for me. Proud and that I'm really, really happy, and I've never done this before. Anirudh, I've known him as a teenager, and he's grown in my house on the couch watching TV, playing video games, and playing poker and late nights, and he was my son's classmate. So that's how I know him for a long time. He is from the region, born and brought up in the region, went to North America, and then back here now. But he will tell you a little bit about the region. The introduction was there. I will not go further into the introduction again. This is about 2 exits that he's had and the 2 companies he's built from scratch. He has co-founders, he'll mention them. But first of all, to give you the narrative, we will spend 10 minutes giving the story behind. You can go as far as comfortable you are, as back before you, so that people know where you're coming from. It's important to know where the journey started and how it started. So we'll spend about 10, 15 minutes before getting on to the exit.
All right, so I'll go way, way, way back. I'm born in Kashmir in the north of India. We have no entrepreneurs in my family, so I was the first one. We have doctors and teachers. Um, Always was intrigued by this topic, and going to college really fundamentally, I think, changed my mindset there. So, like Deepak mentioned, University of Illinois, home of Mark Andreessen, who's now obviously known for A16Z, but he wrote the browser on campus. So when you walk into a lab and you feel that some other person like you has actually created a browser which we are using even today, that really empowers you in a way that very few other things can. Also coming from India, I think till the last 10, 15 years, we've seen primarily what I call rent-seeking, license-based businesses doing well. And so a lot of the entrepreneurs that were celebrated were people who had either access to license or government and could do some innovation there and get ahead. And usually that involved some not to be mentioned methods, right? But in the last 10, 15 years, you've seen the likes of Flipkart, Paytm, and now you've seen Zomato and these great success stories that have come out, which are just normal, everyday kind of people who have really grown companies out of innovation. And I think that I saw in America when I was there, where you saw, Facebook came out. We were the 10th school to get the Facebook. And so we've really seen that grow. Google was the coolest company to work on campus at that time. It was definitely not worth whatever $1 trillion it's worth today. But the excitement of seeing two kids from Stanford have built something, you started feeling you could do it. And I think that's the most important kind of switch for me from an entrepreneurial perspective. Obviously got an education in the real world business, working in banking and private equity, worked in New York, London, and Dubai. And I often joke that I caused recessions in all those places. So it's not surprising that I'm speaking on the morning where whatever S&P is down 2% yesterday. So I have that great talent with me. But went back, did my MBA at Wharton, and then started Pocket Aces, my first company, with Ashwin, who was my college roommate. And so in that sense, it's been an amazing journey that you get to build with friends. And you're soon joined by Aditi, who's my friend from middle school. She used to sit in front of me in school in Kuwait, and subsequently married Ashwin. So we get to build with friends who are like family, which is also a very interesting dynamic topic for another talk, I guess. And supported by a wider group of people. I think he mentioned I've been at his home many a days with his son and some other friends, always thinking about ideas for the region. And this was 08, 09. And I think a lot of those ideas have come true today. So someone in the pre-talk was asking me, so how do you start? So just start, right? And I think what would I give myself an advice for that time would also be the same, just start. And and we grew Pocket Aces from...
If I may interrupt,
Yeah.
Can you just tell the story? You both founders were bankers.
That's right.
And there was a switch. Both of you working in New York, and you chose to move to Mumbai.
Yeah.
And how did that journey happen? Maybe a few minutes on that. That's probably critical.
Yeah, so for my co-founder Ashwin, he was interested in the media industry, and during the recession, he was literally located in the next building to the New York Film Academy. So he's like, what the hell? Let me start another interest and explore it a bit more. And that's led to his sort of journey in the entertainment industry. And he said, okay, let me move to India, see how things are there. And as he moved, I think he saw that there was a big space for us to do something. Meanwhile, I didn't get my US visa. So this is not only during this administration, it's been happening for many years. So I didn't get the visa, and then I was thinking about what to do. And sometimes in life you get a bit emotional. So I was a bit emotional as well. That okay, I didn't get the US visa. I wanted to run a hedge fund and so on and so forth. And I said, okay, what else can I do? And I thought this is like a calling from higher forces to go explore something new. And Ashwin, who became my co-founder, was a friend. He was sending me all these film scripts, and slowly I got interested on the media side. I had taken a film course in school, so I was always interested, but never thought I would be doing it as a full-time job. Also, coming back to India, I didn't want to go to Delhi, where a lot of my family lives, because, like I said, they would be like, "Why the hell did you come back? Go back to the Middle East or go back to America, earn the dollars that you were earning." So Bombay seemed good because I had a lot of friends there, and I could, just see how things are and start from a very beginner's mindset, which I think is very important when you start companies. And then, yeah, that's how we both moved, and slowly we quickly figured out that the film industry, which was the kind of first thing we wanted to attack, you have to be a bit naive to start a company, right? Because the odds are like some 99.9% against you. So we thought, hey, like Indian movies, everybody knows Indian movie stars from Raj Kapoor to Shah Rukh Khan, everybody knows them. The cultural context of India was much larger than the economic context on the media side. And so we felt that, what the hell, like the whole Indian film industry is $2 billion at that time. 1 billion in Hindi, 1 billion the rest. And Lord of the Rings can do 2 billion by itself. Like, that made no sense to us. So as sort of naive or bright-eyed entrepreneurs, we said we can solve this problem. And that's how we actually started. Obviously, as soon as we started, we realized the film industry is like what I call anti-startup, right? Startups have to be fast, nimble, cheap. Films are exactly the opposite. You have this large fixed cost in making a film. And every time you'd sit with a film producer, they would tell me in India, they'd say, we have to get a recovery. And I was like, recovery? Like, this sounds like a bankruptcy. Doesn't sound like a real business. And that's when we said, like, we got to change we cannot be in this industry. And we started keeping an open mind of what's changing around us. And we saw that people had started consuming content on the phone. And that, I think, was like late 2015, I want to say. And that was a seminal moment for us, because we immediately flipped. We stopped doing any work on the film side, moved all our resources towards digital. Interestingly, we had just sold our angel investor on the film story, and funnily enough, signed the term sheet here in Meadows, in the Costa that used to be there. Now there's Boone there. And this gentleman was nice enough to back us. Then later I realized he was clever enough to back us. That time we thought he's just doing us a favor. And we told him that, look, we're changing the complete business that we promised you. And he said, look, spend the money wisely. This money is for you, and you guys will spend it the right way. Don't do anything bad with it. Rest is good. You will find something good to do with it. I trust you guys. So he stayed on. And of course, then we grew that. I think, I don't know what exit he got, but pretty large multi-bagger exit. But yeah, that's how we started. And then we started doing everything on the phone. We started making videos on the phone. We started distributing digitally. We made shows on the phone. And that fundamental shift in the cost structure that we brought allowed us to build our first business, Pocket Aces, because it was built on the backbone of short video. And what we brought to the industry was, that we obviously took advantage of this massive distribution that was there, and more people were watching, and very few incumbents actually saw it, right? Today, all of them have changed. I've been on multiple panels where you'll find on YouTube where, in India, sometimes debates become yelling matches. So someone is yelling at me that, no, TV is the main thing. And because I gave a talk, 2018, that of how TV will just die, right? In terms of like the distribution method. Obviously, we use television as a output, but I talked about how, linear basically. And I had 3 multi-million dollar CEOs sitting with me on screen and on stage, and I was the only one who was like a small company. And now all of them are all running OTTs, of course, and they all promote digital because that helps their business now. But it was a big mindset shift, and so we had this open field. Like, nobody was attacking us. We could keep building, and we worked with talent which was not getting opportunity anywhere. Just like a lot of other businesses, the film business in India, entertainment is very family run, right? And often I often say those families actually do a better job than a lot of corporates do in that sector. But that also means that there's no entry available for a lot of people. So talented people would just be waiting outside, and even with the best intent, a big producer like a Karan Johar or Adi Chopra, like they just don't have the time to meet young people, right? So those people would then come to us, and we would work with all of them. And slowly, people started saying that, okay, this is where new talent gets its due, and we'd just give them a project to do right away, and that's how we got started.
You think you were the first mover in this?
I wouldn't say we were the first mover. I often feel first movers are at a very big disadvantage, but we were early. We were not like much later. Like we were fairly early. We were one of the first 5-6 companies that was there. But I think we came from a very analytical and, again, I say like beginner's mindset. We didn't assume we were right. We didn't think that we know better than the audience or the better than the consumer. And I think we brought that startup, what now is well articulated, that thinking to the media industry, which didn't exist. So simple thing is, we use data very effectively to figure out what to make and what not to make. And we got that response on any video. Let's say I cast you in a video, and suddenly you will find that people are just talking about him in the comments, whatever the script. So I'm like, okay, this guy is like, has what in Bollywood is called the X factor, right? Like people just love watching this person on screen. So we just started casting that person more. We tested storylines. So it'd be like, one of our famous videos early was annoying things girlfriends say, okay? And mega viral video and like 20-30 million views at that time. And in the comments, people were like, oh, well, the boyfriends are annoying too. And they started writing what was annoying about the boyfriends. So we don't even have to write. It's like the script is written in the comments. So we literally took that, made a corresponding video. And then we made a show from those 2 videos called Little Things, which went on Netflix. And we were the second company that Netflix partnered with in India. So all of that came from a very low expense base. So I had one really famous Indian actor called me once to his office and said, look, I love watching your guys' content on my phone. How come you guys don't use like a better camera? And you use a better camera and slightly better looking people, okay? I said, if I do both of those, I cannot experiment, and I cannot find these other people who are now famous who you don't consider as good. Because that is exactly the bias we were fighting. That just because someone looks a certain way or the content is a certain way, people just didn't promote it, because that's the old mindset of film where, it has to look a certain way and mount it a certain way. And that's how we got started. And I think that the data-based mindset and the fact that we were not trying to ever be in front of the camera, I think that was a big difference. Because early on, a lot of creators, and it's true today also, which you'll see on this TikTok Snap generation, is that it's a creator-led model where the creator is in front of the camera all the time. The problem with that is that at some point, the creator loses relevance. Like some creators, obviously, I have agreed, that's very, very rare. But most of the times, you can't promote anyone else because you keep thinking, I can do it better than him. Whereas for us, I always told the talent, my biggest talent is that I have no talent. So I'm never trying to compete with you. I will promote you to the best of my ability, and I'll give you the opportunity to do it. And then you're on your own. And I think that served us well as we grew the business.
Excellent. That's the first part of the story. And how did Loco come about? It's completely different sector, completely different dynamics. How and why did it happen, and what does Loco do?
Yeah, so Loco is a large live streaming platform today. But we started Loco with a very, both these companies started from a whiteboard. But for Loco, we already had Pocket Aces, a slightly larger whiteboard. Pocket Aces literally started from my roommate or co-founder, whatever, however you want to refer to him, as from his couch in Bombay. So we had a little whiteboard in front, and that's how we started. But with Loco, it was very different because we had started the short video or direct-to-consumer business in Pocket Aces. We had an OTT business where we were making shows for Netflix, and we had some other contracts also on the way at that time. And what had also happened was because we had scaled our direct-to-consumer offering, there were a lot of brands were working with us. Like, the top brands in India were working with us. Our client retention was 95% plus. So, and they were getting amazing returns from working with us. And so what was happening is these guys were like, hey, how about actor A or person B in your video? How do we make them our brand ambassador and can they do work with us? And initially we would just connect them like, oh, it's just a friend of mine, I'll connect you on WhatsApp. Then over time we started realizing that that's actually a business called talent management, right? And we should do that because a lot of these guys were getting extremely large as soon as they were in our videos. Second is they were very poorly represented, so they didn't have any idea of how to build their career trajectory, right? And how to maximize that sort of surplus that they were creating. And so that became our third division, which is the talent management division. It's called Clout. It's amongst the top talent management divisions in India today. And then we started thinking, okay, this is so far we've bet on Indians using the phone to consume. What comes after this? And we felt that people will not be just incentivized to consume. The next sort of leap after that is interaction. And we felt there was a complete white space in gaming in India. I mean, growing up in the Middle East, we often in your home as well, we played the Wii, we played PlayStation. We grew up around games, right? And India didn't get that because console penetration and PC penetration was very low in India. And mobile games were never of that quality. That changed when internet became fast enough, the phones became cheap enough and good enough where they could run these games like Free Fire or PUBG Mobile on the phone. And today you can run a lot of good games on the phone. So we felt that would be the game changer for India, is that the mobile penetration was already good, 5G was on its way. Then it was just a matter of time when the games that India liked would come about. And it was not very far after we thought about that, we first launched Loco as a live trivia platform, which was like playing Millionaire on your phone. So there would be a live host, and we'd go live twice a day, and there was a pot of money at the end. And so if you answered all the questions correctly, you would share that pot with whoever participated. And this thing went like mega viral. Like, it was not this. You see virality in that you get 10,000 or 20,000, 100,000 users. I told my tech team, which we had just put together.
This is out of Bangalore.
Yeah, out of Bangalore, we had a small tech team we had put together. And I worked on Loco from day zero as well. And with any new thing, this is something that I always tell other founders, that you should be involved yourself. Don't give it to someone else, because it will never get that relevance in the organization and the speed that like a startup needs. So I worked directly with the what we call the Loco team at that time in Bangalore, and I told them, look, the success will be 100,000 users, daily active users in 6 months is our target. Right? This is circa 2018, and this is our aim. And I was confident of getting there because we had this large digital footprint. We could promote it. We launched it actually from your house, if you remember. Yes, Feb 13th. I remember it was like right around Valentine's Day. We were sitting at his home actually, and that was the big kind of, we had done the soft launch, but that was like the first day we were going to launch a promotional video with the same couple, by the way, which I was describing who were in the Netflix show. There was no Netflix show till then, so it was just all on YouTube. And we said, okay, we'll just get them to make the video and we'll integrate it just the way we do it for every other brand. We launched Loco with that single video. In 3 months, we were at, I think, 3 million monthly active users.
Wow.
3 million monthly active users. I remember flying back from here because that day also we were expecting maybe 2,000 users. We got like 15, 20,000 users, and it was going up every second because this thing was mega viral. People were playing in hostels. If you went to Bangalore, Delhi, even smaller towns, people were playing it at the 2 times that we would go live. I have pictures of people playing it in mosques, people playing it in the barracks, in the hospitals. Deloitte and Flipkart started having Loco days because the HR was like, well, if you can't beat them, then join them. So they started making like days. So it was quite insane. And I remember going back, and our CTO at the time, I told him, is it going to work? And he said, yes, it will work today. I said, are we going to be ready for the scale? He's like, definitely. And then I saw him go in and he was just praying in the room. and that's when I knew that it's not all science. But yeah, that's how we grew. And we started filling that sort of white space in gaming. And then there was a journey with that. Like we saw that people got bored with it over time, which happens to a lot of games. And longer sort of what we call forever games like PUBG Mobile and Free Fire also showed up at the same time. And luckily we had this, working with younger people, I mean, I was the oldest guy, actually Ashwin was the oldest guy in the office. Working with younger people, you saw what they were doing, right? So I saw a lot of people around me playing the game, PUBG Mobile. So I said, oh yeah, I'll start playing it. And then one day at 4 a.m., I'm sitting with our CTO at that time and saying, what the hell are we doing? It's 4 a.m. and we're both still playing the game. That's when we knew like this is a great product, that this game is going to be used by a lot of Indians. We started meeting people from like small towns. They'd ask us how are things in Bombay, how are things in Bangalore. Some would be just sort of hanging out online. Others would be like, can you guys never play with us again because you're so bad? And I'm trying to reach the national championship level, right? Because they were in the esports sort of target. So you started finding these new cohorts of people, and that's when we knew like, and when we saw YouTube was nowhere on live streaming in India, they were not promoting it. It was not top of their agenda at that time. It is now. And that's when we said, okay, we know we have the tech already because we are doing this large concurrency streaming and we can move it to user-generated content. That way people get less bored. And yeah, we pivoted early 2020 and yeah, that grew very dramatically as well.
How many users now on this?
Well, it grew to close to almost at its peak, almost close to 10 million monthly active users.
All right.
So it was very large and of course, it went through its own journey because India has found its feet in terms of regulation around this stuff. It's gone up and down there, but
we'll talk about that.
Yeah, we'll talk about that. Yeah.
Well, now we're coming to the main topic. I thought it was important that you know the background a little bit. Any questions on the background so that before we get into the topic? If there are none, we can proceed. Okay. When did you think that Pocket Aces is exit ready?
Are you ever really?
What inside the company gave you that signal, or outside the company, was there a market signal for Pocket Aces?
I think are you exit ready is a very important question or difficult question to answer because I think it has many facets to it. As you said, there's a market signal, there's a scale signal, but there's also a personal element to it, right? When you start a company, very rarely do you think of the exit. Like, people put it on a paper, but I don't think mentally they're even ready to even think of the exit. And we got offers along the way, and we just felt we were going to get much larger. So I think the market signals were there. For us, the important thing was we were thinking of only an IPO initially as one very credible way of exiting or taking it further, and where we felt that, okay, for that you need to have predictability in cash flow, predictability in terms of revenue, so that analysts can look at that business and sort of just predict what's going to happen. So that was the first thing. But over time, what we started figuring out is that, and this is my personal viewpoint, is also startups are innovation engines which larger companies cannot have often or do not have. And so we started thinking of M&A from that perspective as well, is that could we add value to another larger company or another company in the sector? Either we buy them or they buy us, and can there be value created that way? And M&A is typically, and you know this very well, can be highly value destructive. But we had bought 3 companies inside of Pocket Aces, and all of them did very well for us. Loco itself, we had actually brought the initial tech team in. We added a games unit on top of that. And then we added a third startup, which we felt had a phenomenal team, but they also got stuck by regulation on the news side. And we brought them in, and most of those guys are still with us and working very alongside us. So for me, I always felt that what they could do for us, can we do for a much larger company and offer them an innovation angle that they could have never explored. So this could be an older media company who've woken up and said, okay, we need a new media arm. It could be an e-commerce company who was looking for a content to commerce play. It could be an international company which is looking to expand into India. So there were these sort of angles we explored. So that's when we felt, and in terms of the scale, we were at the right scale. We felt like in terms of revenue, we asked, obviously we hired bankers to get a sense for what is the right scale for going public. When could, like, say, later stage private equity come into the business? So we explored all these different financing options.
And was there any pressure? Which year did Sequoia come in?
Sequoia has been an investor since 2016.
So there was no pressure from Sequoia, or they
Yeah, and there's no pressure per se. I think the investor base, and this is quite interesting, is that there was no real pressure because I think these are longer term, 5-10 year investments for all these guys. So there was no pressure, but I think there was obviously pressure to grow and innovate, which is good to have. The bigger priority for us was how to not die, because there were many places where you could have died in the middle, right? Mortality risk in all these startups is high. So 2020 could have been quite challenging, but we did fairly well there, and having a diversified business base there really helped. And we took action early in 2020. I think one of the few startups that really benefited from what happened, unfortunately, in that time. And we were that was the time where we started thinking, okay, it's been about 5-6 years since these guys have come in. Should we take our next leap as a company? How do we make the next sort of jump into from a revenue perspective or an industry relevance perspective? And that's when we actually separated the companies as well. Because Loco was part of Pocket Aces till then. We separated the two companies out because one of the things we heard constantly from the market was that we either found a cohort of investors who were very interested in growth and they didn't like profit that much. And 2 years later, everybody flipped and they just liked the profitable businesses and not as much the growth businesses. And we as founders felt both these businesses have their own place in the world. And I've heard innumerable number of times people telling me to shut one business or the other. And that's when we said, okay, if we separate them, we can then get the right capital in place for each one. And I think that was a very important step. And, we are very thankful to all our investors. It was not easy to get everyone on board, but at least I think the key guys in our cap table were supportive and saw that very early that it can make sense to separate the businesses.
And when you did separate the business, one of the learnings was company formation and where you formed the company and the problems you faced with the first one and the second one.
Yeah, I think that when we started in India, we just put our company in India because we thought that this business we were not thinking big enough maybe in that time. But as soon as we became larger with game streaming, I felt that this could be a large international business. And, often in India, even to send capital abroad can be tricky. Like it takes time. It can happen, but the people running larger businesses are in India, but it takes time. And when you're small and you're trying to compete, velocity is like one of the most important things you can have. I mean, even till today, after these exits, working with other folks, we are always very, very keen on the velocity bit, that you have to move fast. Because otherwise, you have I often, people ask me, what is the moat for a startup? And I say, startup has no moat. You've not built it yet, right? Obviously, you find one as you go. But one thing you do have, which is much, much, much better in terms of its quality than any large company, is speed. Because, you worked with large companies. I often say, in a larger company, you're playing defense because you've created all this equity value, there's an asset, people don't want to lose that asset, which makes sense, right? If you hear the Buffetts of the world speak, I think you talked about a very interesting thing, the inversion principle. What is this active stupidity you can run away from, right? That's often very important. So that's a very important question people in larger companies ask, how do we not lose value? But that's defense, right? And that has its own value. But when you're in a startup, it's about offense. So it's how do you take chances where you can win non-linear opportunities? How do you get into them? How do you move fast? And moving fast often is the difference between even these small companies that we bought, there was competition. It was not like nobody else was bidding on them. We often won because either we showed up, we were there, we were fast. And so I think that speed is something that is something that I promoted through these organizations, and I felt that going international, we needed to be in a jurisdiction which would support that. So let's say we wanted to buy someone in Africa or something. I don't know. This kind of, it's like hypotheticals, obviously. Can we move fast? In India, to send, I have to fill a form, CA, CB, you have to do some filing, and it takes time, right? Whereas internationally, if you're in a better jurisdiction, or a more friendly jurisdiction like Singapore, UAE, Abu Dhabi has, Dubai has now created excellent jurisdictions, you can move fast. And we really have benefited from that in the long run. But that doesn't mean it's one size fits all. Like you can see now a lot of Indian companies are flipping and coming back because they want to list in India. So I think it's more a question of what your aim is with the company. If you feel you're just going to be India focused, then being in India is fine, maybe easier. But if you feel you have international relevance and ambition, then you must consider having the right setup abroad.
Thank you. In terms of the clarity of the strategic sale which you did with the first company, the second one was not a strategic sale.
Yeah.
So you'll have that. Yeah, in terms of the point where you decided it's going to be a strategic sale, was it inbound or was it something you had to play to?
Actually, one thing we realized with an exit is you don't know who's looking for you, because you don't know, there's an information asymmetry, especially in an M&A, right? How valuable you are to them and who they are is you don't know always. So I think you definitely need a good banker. But I think also you need to keep your mind open to various possibilities that exist. And so I think for us, it was inbound. We had multiple offers also for the Pocket Aces asset. And we then had to think about, how do you choose? First, you have to mentally prepare yourself, because like I was saying earlier, you don't think of the exit at all. You feel like you're going to be building this forever. And I think you have to then get into that mindset that this is not the end, but the next growth phase for this company. And the company itself is a creature that you have to treat or nurture in that way. So I think that little bit of that, postpartum, if I use that word, has to be dealt with by every founder. But after that, once you get your mindset right, that, okay, like what is the right thing for shareholders? Is it the right thing for the team that's there today? Because they've all worked hard to build something. They need to be in the right sort of culture. Is your next strategic step going to be supported by these people? Are they real? This is, oftentimes people may just come to find out, take a nice tour of your business and, not do anything. And not that I'm never worried about people copying our business, because that's going to happen. But more about wasting your time, because you prepare all data room, and there's a full, there's a team working on it, which could be better utilized doing other things. So yeah, it was inbound, but we had multiple inbounds, and we created a process so that we have.
And you were 3 founders, so that should have helped the process.
Yeah.
Nothing.
Yeah, it did. And what we did is we actually split up. So, and we had a good CFO also working with us, and long time he's worked with us. So there was a great deal of trust. We had good bankers also who helped on the way. But more than anything, I think it was more our own mindset towards the strategic acquisition that helped. And I think, Ashwin, my co-founder, was very instrumental in helping us realize that. So, I was always of the mindset that we keep building.
So, on the flip side, Loco, you exited to a private equity. How did that pan out? Was that different, very different from, or what were the reasons? And I know that you're not fully exited it, but majority You have
Yes.
exited now.
Yeah, we gave an exit to all our investors who had initially invested, which was some very large venture capital funds. They had obviously invested with the mindset of investing in an India company which will then grow abroad. But because the Indian regulation on gaming has changed so much, right? So to give everyone context, India and China had political differences because of which all Chinese companies were effectively banned from India. Most of the big mobile games, video games, are Chinese, right? Like they're published by Tencent or NetEase. So, so that created a problem for us. It's like saying, what will Hotstar or Jio do if cricket is banned in India? Because most of the stuff that was consumed, content that was consumed on Loco or broadcast on Loco was
Chinese.
yeah, there's gaming, right? Like so, people playing PUBG Mobile or Free Fire were the two biggest games. There were 90% market share in India. Still continue to have that. Then we still said that okay, gaming will still be large in India. Do we believe in it in the longer run? And we said yes. So we continued with the mission of being a live streaming platform. Got one of Korea's premier gaming companies, which is the actual creator of PUBG, to invest. So they came back. They brought PUBG Mobile back to India as Battlegrounds Mobile India, which is still I think the best or most widely played game in India. Game came back, and then the Indian government suspended them. Excuse me. That's when we thought that, okay, look, we had close to 10 million users, monthly actives. Streaming is an expensive business. We could be, let's say the game again came back, which it did. We could be at 50 million. What if the government changes its mind again? We would be bankrupt in like 2 months because in India, revenue takes time on platforms, and you can see it in so many different places. That would create a big issue for us. And that's when we said, look, but we obviously have this great asset that can scale. There are other countries which have mobile gaming is big. And so we need a different investor who can fund that ambition. And that's when we started keeping an eye out for different folks. And funny enough, this investment came through a simple LinkedIn message.
Really? Yeah.
And, like I said, you have to keep an open mind. And I replied to the LinkedIn message. So I was like, is this, one of those online scams? Like, am I going to get scammed here? And I was like, okay, we'll see how it goes. And it was not a scam. And it turned out to be a very legitimate banker. He had no other way to reach me because he's based in London. And so we got ref checks done on the person, and our investors knew them and said, yeah, they're legitimate guys. And we had a very good investment bank working with us out of London. They met them. And that's how we got going on this one. So it's completely different. One is like a publicly listed company. Other one's a private equity style office. It's like very different styles. And I think for us, also very different in terms of the diligence we did on them, the strategic angle, all those were quite different.
Okay, now coming to, any questions on this initial part? Please go ahead.
Hi, Kulveer Singh here, founder of Recept. Actually, we are on a pre-seed stage. Wonderful listening to you, actually. So you asked about the pressure from Sequoia on exit. So like, as a pre-seed, we're looking for investment and all that. What is the typical investor mindset investors come with? Like how long of the exit they're looking for? 1 year, 5 year? Like what is that period, if you can?
See, it's different for different people. So if you get an angel, they may have no exit horizon in mind, which is forced upon them. They may have an internal way they operate. So some angels want to exit in 5 years or whatever, right? But as soon as you go to the funds, they have a fund life. So they are also responsible from a fiduciary perspective to deliver an exit to the LPs. And usually they have 5 to 10 year fund life. So anything in that time frame, you can keep in your mind that they will be an exit. They'll start knocking at your door. So I had a few, not Sequoia, but some other smaller investors. They did knock at our door, but very politely they said, "Hey, are you guys thinking of delivering an exit?" And you can deliver an exit through obviously through an IPO. You can deliver an exit through a sale, but you can also do a secondary sale. So there's different ways of doing it, and we have delivered those sort of sales as well along the way. But yeah, it depends on the investor, and I think a really important thing to think about as where you are right now is as soon as you get your seed and let's say you grow fast to A, you're going to have different investors come in each time, and they may have different rights. And so be very mindful of what rights you're giving people, because when the exit happens, you will not control the valuation, because the valuation could be is obviously your quality of your business, but it could also be the markets, right? Nvidia was the same business it was yesterday, and it's down 10%, and tomorrow it's up 10%, right? Business is the same, but the value you will get as a founder in the market could be different. But that also means different people in your cap table could be at different different IRR returns, and that will change the way they will play the game. So you have to be very careful around that stuff. You know, things like liquidation preference, which is a key term sheet, sort of term. Be very careful with that. It's not written in a dirty way. It's not written in a way where it's sort of a hidden clause. I've seen some term sheets that have that friends have gotten where, you know, there's a hidden term there, like there's an IRR which is, you know, accruing in the back. So there's ways in which VCs can protect themselves, and you have to remember that as a founder, that if they have lick pref, it's like having debt. You have to deliver that return, otherwise you get nothing as a founder. And you will have, and that's something you also have to remember as a founder, like this equity belongs to you, and it's a return that you will get for yourself, your family, like this. That's an important aspect of it.
Exactly.
So when you're negotiating the term sheet, those are things to think through. Because you will get desperate at that time, or they'll put pressure on you that I'll send the capital today, or like, you know, I'm a big investor, you want me in your cap table.
Yeah.
The best investors usually have standard terms. So I have not seen problems with larger guys, but smaller guys often do this, where they try to add value for themselves through these hidden mechanisms. So be wary of that.
Preferences. Thank you.
Go ahead, Denise.
Thank you very much. So the process of selling the company is always very painful. And can you share of some of the tips for how to navigate the inquiries of the potential investors, to making sure they're real, serious, or not wasting of time? And also, how do you protect your data in terms of when you share the data room? How do you know they are not getting the secret of your business and then getting to their business, and what kind of potential investor you will stay away from?
Thank you. This was exactly the next part of the discussion on process.
Yeah, I think I'll take the first sentence you said, that it's very painful. I think the whole company building process is painful. So you get used to that level of pain. So I think the exit has a different, I think I mentioned it earlier, emotional, I wouldn't say pain, but like the mindset shift that needs to be there. And this could be an exit to the public. This could be an exit to another investor. It could be a secondary sale. You could lose control of the company. These are all different places where your operating mode needs to evolve. So I think that's the first thing, is which operating mode are you in? There's a different playbook involved. As you get more investors in, even if you stay private for long, your shareholding often declines to, you know, a place where you're not like, say, 40% of the company as a founder. So the corporate governance has to be solid. Your reporting has to be good. Those things you should be doing day in, day out anyway, for yourself first. Make sure that simple things that you think are not your business, but actually are your business, which means compliance, paperwork, those things have to be clear, because those are like the obvious stupidities that turn off an investor. Like you have a lawsuit, or like something that's outstanding, some liability you've not settled, some tax bill that's just staying there. You know, settle those things, make sure that those things are clean, because that's like an easy way to get rejected, right? Like that's like, nobody needs to think about that. They'll be like, yeah, I don't know what's in this company, that's rejected, because you're a private, you have to think about their mindset. That's really important. When you're selling, it's very important to put yourself, or at least understand their mindset. They also have no information on you. So I would almost go the opposite way, where I always think of what is their incentive and what are the incentive structures, and how do I make this successful for them? Because that then helps me understand, or at least and discuss with your advisors, because they'll know them, what is their incentive to buy, right? So that's the first thing you need to understand. The compliance bit, data needs to be clean, and it's in a very easy to consume format. I have often written memos. I prefer doing that, where I write what I think the company should be and is. So that way anyone can just read it. And if they are on a low effort mode, they can just paste into their investment memos from my memo, right? And also helps you as a founder then to think deeply about different issues. Data room clean. I think in terms of the confidentiality, I think provide enough data where they can make a decision. And then once they get serious, you can add more data. But I think the first thing is figuring out the incentive and meeting them and understanding why they're doing what they're doing. I think once you understand that, then it's easier.
Ajay.
Thanks, Anirudh. That was brilliant. You mentioned IPO. Most founders I know are fascinated by that 3-letter word. Can you tell us specifically why you chose not to do an IPO for both your, I think you mentioned for the first one, Pocket Aces, you did consider an IPO. I don't think you mentioned it for the second one, but I must have come up sometime. Usually people think it gives the best value. So what were your thinking behind not choosing it?
Well, luckily, I've been a banker and a private equity investor, so I also know being public is not, there's a lot of compliance work and difficulty that comes with it. But also, I think people like it because it's like, it gives you sort of this, what has been perceived as a successful release, and you get the most. A lot of founders think that's the best way to get valuation in the market, and you still stay in control. Obviously, from a technical perspective, the access to capital is easier because you are publicly traded, you can go to the market. That's changed a lot in the last 10, 15 years. I mean, you have companies like Uber, which stayed private for so long. There's like SpaceX is still private. Like there's a lot of private capital available now. So I think that's changed. So I think the motivation to go public becomes then more emotional for a lot of people. I think you're absolutely right. People are more fascinated with it than they should be. It's not that important. There are other ways to get value. I think you have to see what works well for you. For us, on Pocket Aces, why we considered it was because we felt that, okay, we are getting to a place where there's going to be predictability in revenue and profitability, which we can then take to the market. Obviously, the growth in the business was better than where the kind of incumbent media sector was. So multiples would add. I've met a lot of research analysts. They wrote reports on us also, actually. So we did investor days with them just to educate them as well. So got a sense for how the research guys cover you. So we were considering it from that perspective so that we can keep our, to Denise's question, the infra ready. So the data, what they need to know, is there any compliance work that needs to be done? Because all that has to be done alongside your actual equity story and taking it to the public, and what sort of investors will be anchor. Those are more later stage, but at least the basics have to be done. So that's why we thought that, okay, if we're going to go public, do we have the right sort of reporting? Do we have the right corporate governance? What kind of board would we have? So that at least those things we start thinking of in advance. So those are important. And then, of course, for some of the companies that are coming back to India, they've had to flip. They have to pay like a liability or whatever to the government for the tax. So there's more steps involved. But I think you're right. The fascination with the IPO is more emotional often than, I think you ultimately have to see where you're getting the best cost of capital, the basics, and what terms you're getting it with. People think that the public markets are easier, but I don't think they are. I think they're much tougher.
Coming back to the process, speaking of bridging valuation gaps, how do you think about it? When do you think of earnouts? How did you think about your own valuation target which you had? What problems which you came across? So I want to complete the process part of it. There are many parts which we have to go through.
I think you look at valuation, there's obviously publicly listed comparables, there's where people have transacted from a transaction perspective. More importantly, where you think the growth of your business is going to be and what your metrics are going to look like. So I think a lot of those things go into the valuation that you will accept. Let's put it that way. Your valuation is obviously what you think the future value of your company is going to be.
So earnout is always thought of for now.
Yeah, I mean, the earnouts and those things can come later. I think the first question is, are you even in the right zone for someone to consume?
Okay.
Right? So I think you have to think from the seller perspective, from the buyer perspective, that like if you're in a certain zone, nobody can buy you. This can also happen, right? Like if you're too big, nobody can buy that. Like the buyer universe just collapses because how many people can do $5 billion acquisition? That universe is smaller, but then 100 million, there are many more people who can do it, and you can still be valuable to them because see, you still have to make money for them. They are also managing someone else's money, and I think this is where I think this sort of mindset of I just want to maximize everything for myself and not for the other person doesn't work in this scenario. You have to think in a way where, okay, if they are buying you at 100, can you be 500 for them? Because they are also buying something that should be valuable for them, which is when they will pay a premium to buy you, right? So I think the question then becomes, is it going to be a premium over the last round so that everybody in your cap table makes money? Is it much lower than market price? Then obviously you will not accept it. But broadly, the valuation ranges are often, we will see with these things in the right zone. The question then becomes more around, are you getting stock or cash, right? And which one do you value, right? Like today, you could get, for any company, you could get stock in something that might go public or something that's already public. And so now that's on your risk appetite, your investors, what do they want? Are they okay keeping that equity? Or do they want a cash sort of exit so that then they 100% know what they're getting? So this math has to be done, and that's where things get tricky because different investors have come in, to your point, different investors have come in at different times, right? So let's say investor A has just come in now, they have 5 years to go. So they might be willing to take stock because they're willing to see how it goes. Someone who's been in your company 8 years, they're like, give me some exit, something, right? Some guys might take a stock because they are just working at a fund. So they can write a number in their Excel sheet and move on. Others have real commitments. They have to give money back to the investors. So there they want cash. So this becomes more tricky. The second bit is the earnout, like you're saying. So there are ways, if your valuations are different, you can bridge that through these sort of structures where you could do 2 tranches, see how the business grows.
Which means that you have to keep partial control of the business.
You have to keep partial control of the business. You also need your shareholders often to stay with you. So let's say if you are doing multiple tranches and the new investor or buyer doesn't fulfill their commitments, what do you do in that case? Or if you're left with one big buyer, then you have no leverage, right? You're not going to go to court. Like these kind of things are not really, practical. You don't want to be in that situation. If you're in that situation, it's already bad. So what you want is a way to commercially create the right incentives that everyone does the right thing. So having other investors, if you're doing 2 tranches, having some investors stay with you is also is very important because they then provide that sort of independent pressure and a third-party perspective, which you would not get otherwise in a boardroom. That's why if you sell to one big investor, I always say, unless it's publicly traded, take cash, is my personal view. Because ultimately, to get the stock out then, you don't know how it's going to happen.
So one of the key things you're saying is that has the buyer, if you're a strategic buyer, they have a multiple. As long as your acquisition is accretive, then it's fine. The problem starts when it's not accretive. That's where you start.
I think if you think from a buyer perspective, it has to definitely be accretive. And from your perspective as a seller, you have to see, A, are the shares going to be worth something to you in the long run? B, what is the ability for you to get liquidity on those shares, right? Like let's say there's a private AI company that buys, say your company. How do you get liquidity on that tomorrow, right? So this becomes like kind of the questions you have to think through. And we've had offers from companies which are high flying at one time. They were happy to pay us in stock. Obviously for them, that's the cheap currency to pay in. But we just felt, and now it's proven wise, is that going with someone with the right balance sheet, right operating history was wiser, and that works out better. So I think you have to choose each thing. It's not a one size fits all, but I think the financing mix and who's there makes a difference. If there's a valuation gap, right, and you have an earn-out type structure or a multi-tranche structure, then you have to think about when the liquidity event comes in the future, what is the buyer's incentive and what are the bad incentives that have been created? Because, you know, you could have a rogue player on the other side, then what do you do? And how do you make sure that they do the right thing? Or don't, you know, I've heard of too many horror stories where, you know, acquirer will come in and just drag you out on the, you know, on the liquidity. Like they may give it to you 1 year later, right? That's, for you is painful, right, at that point, because you feel emotionally it's painful and economically or whatever, cost of capital loss as well. So I think having the right investors, right structure is extremely important, and the ability to enforce that structure, not legally, because I think there's obviously a letter of the law and there's commercial reality. So I think you should be working towards a commercial reality versus just what's on paper. Because you may get assurance from a lawyer that, yeah, we can win this in court, but you don't want to go to court ever.
Ever. Absolutely.
Right? So you want to just do it commercially and work in a reasonable manner, which is why I also think on the valuation, you should just be pragmatic and not try to, you know, just go crazy on the valuation, because they also have to make money. As long as your investors are doing well and it's in market standard, I think you're in a good place.
Thank you.
Sorry for that. So, is there something like preparing a strategy for partial exits for your investors as well? Like, do you prepare that at early stage?
At an early stage, I would focus a lot on just the 0 to 1 and the scaling, and if you have the right capital runway for that, right? Because runway is just a way of buying time for you to do more experiments to grow your business. So I think I would focus a lot on the first, like at your stage, which is an early stage, is just figuring out, do I have the right model and the right product, right? And do I have enough financing for that? That's all you need to keep thinking about. And at that point, I wouldn't worry excessively about the valuation again. In general, I think mortality risk is much higher than the valuation risk, because you can recover the valuation, but if you die, you die, right? And that death is real. Like in the early stages, like capital will disappear so fast that it will feel like you're in a completely different time zone, like different planet. Like it'll be like you know, are Tom Cruise one day and the next day you're some extra that nobody wants to cast. It goes that way, and it can happen. So I think if you have investor attention, take it. No need to be too greedy. Obviously, put the right terms in. Like I said, the terms can often hurt you more than the valuation. Okay. Right? I can give you a big valuation, like, you know, we were discussing today, in AI world today, seed stage valuations are like $5 billion, $7 billion pre-money, which seems good. But if they're raising $1 billion and there's a liquidation preference, that means the investors will get their 1 billion before the founder exits. Okay. So you're by definition then saying that my business should be worth at least $1 billion plus some return. So the 5 billion is great on paper, but you can't often trade that. So my viewpoint is, on the early stage, focus a lot on just getting your product right and having enough runway to run those experiments, and try to stay as cheap as you can in terms of your burn. But in terms of, as soon as you get to some scale and you feel there's enough demand for your equity, yes, you can provide exits. And my personal view is that if you can clean out your cap table and keep 3 or 4 credible players, that's very important. I think that's one of the lessons I learned in my exits, is that the trouble and the kind of trouble you will get, or the pain you will get, is unexpected. We've had someone tell me that I can't get my share certificates because I'm traveling. And now this is not a big problem, but if you're trying to close a deal, and like look at the markets right now, right? Like AI seems like, oh, like everybody's worried about a bubble and all this stuff. And you're an AI founder trying to close, every day will feel like 1 year. And so just having some small problem like that where someone can't mail over a share certificate will seem like forever a problem. And there a small investor could be hurtful, but I've seen small investors also step up and support in a situation where we needed support, right? So I think the kind of investors matters. I think what is important is if they play in the market often, that's really good. So you may find there's a tourist investor who's come in from some other country and they've They're here and they're like, oh, we love your sector, we love the country, whatever, but they've never done deals in the sector before, or they've not played consistently. They're a very, very big wild card because they could exit. I mean, we've had a situation where someone promised us a term sheet and disappeared. They literally left the country. Every single founder was left high and dry by them, right? And this is after, I think one of the companies had a signed SHA. Now, technically, like, they are liable to pay that money, but you're not going to go after them. I mean, they're not even in your country, so what are you going to do? Whereas if you have your regular guys who are investing day in, day out, they have a reputation to protect and they're trying to build a business on that. So I think that's quite important as well. So when you have, like, we've had investors from very different countries, and what I've realized over time is that someone who's not credible in terms of like their long-term aspirations in the business can be very dangerous because they don't care about their long-term reputation, or they are not as important in your market. So I think that's something to remember.
Right.
But yeah, secondaries you can work out as you go. There are also secondary funds that exist now, and that can be available. And at that time, I wouldn't shy away from providing an exit to some of the early investors and just cleaning it out. You have your big institutional guys, because they will work with an economic mindset versus an emotional mindset, or they have other things going on in their life, or you're too small for them where they don't care about you. That can also happen.
But in the start, you get people who are actually more emotionally attached with the kind of thinking.
Exactly.
Yeah.
Exactly. So you have to, that flip has to happen over time. And I think I would promote that if you can get people out of the cap table, do that.
Thank you.
Most important topic now, cross-border exits and regulation, and what regulations play. How do you have to gear it from day one. You cannot wait for the end, and what do you do in the end, and how do you manage such issues? I'm sure you have had problems both in the Indian regulation, UAE and Singapore as well.
Yeah, I mean, with the regulations, often it feels unfair, honestly. Like, you feel like, oh, I didn't know this existed, or is this how they interpreted it? This is not the right interpretation, right? Like, so you feel a great sense of grievance with those things. So what I would say is, early on, invest in a good lawyer. And they are very, very important. Having the right legal advice is extremely important. Invest in a CFO. Get a good CFO, this is like plumbing for your company. Most people don't think about this, but that's something we did well, I think. Early on, we realized good HR, good CFO, good legal. Once you have that, you at least have your infrastructure, and then you will get the right advice. And whatever curveball comes your way, it could be anything, you at least have people who've seen different situations and have the playbook for it. That's all you really need, is like, what is the playbook for this thing? It could be a PR disaster. Someone's, you go, like, we've had people write like a rant against us or something, right? Like this, all kinds of things can happen. How do you manage these different situations? And you obviously they are at a vantage point where these legal guys or the advisors that you have in your board, they see these situations in many companies. So they can give you a playbook that, okay, X had this Y thing happen. What should you do? Your situation is more like this or not like this. And so they can take the right action. But from setting up a company perspective, compliance, definitely invest early on in a good CFO, invest in a good, trustworthy HR person, and a team who can build a team around them, and invest in a good lawyer, because these are just invaluable in my view. It's the left field things which you felt shouldn't have hurt you in these situations, because you spend very little time thinking about these things when you're building. Early on, you're very worried about product and what do your customers want, and that's where you should be spending your day-to-day time. But then you need someone else to think about the sort of the plumbing of your company.
Thank you. Last area, post-close. What should you think of?
I'm in that situation right now in some sense.
The pains which you're feeling now, what you should have thought of earlier.
Yeah, I think, how you take risk, when you take risk, that becomes very important. I think what I've realized is what I thought was fast is not fast enough often. And when you feel that there is decisiveness is very important. So you cannot be stuck in thinking through too many options. I think it's important to move fast in a certain direction and start moving. Especially with capital flows and these things get difficult, much more difficult than you think that they will. I think that's important. In terms of post-close, I think for me, the important things are thinking about your team a lot, because they've gone from, working in a more independent manner to maybe working with a larger company. So how do you facilitate that without them losing their motivation and mojo?
But you still have when you have a small minority stake,
Yeah.
you still have a say in all of
Yeah,
this.
I was speaking more from the Pocket Aces perspective, where there's 100% acquisition, right? So how do you ensure that that integration is done in a nice way? Right? Don't leave that just to the buyer, right? Because you owe something to your own people and to yourself if you're working there for a longer time. And I think those guys have, Aditi's leading that business. I think they've done a fabulous job there.
They have one partner still in the business. Yeah.
Yeah. So we have a partner who runs that part of the business, and I think they've done a fabulous job there. So, even on our end, on Loco's end right now, to ensure that you have the right processes in place, so that, because everyone comes from a different grammar, if you want to use that word, in terms of how they run their company. There's a certain way they want to see their dashboards. There's a certain way they want to see reporting. So that helps them understand what you're trying to do. That translation is also important. Right? I may like to see memos. Other people may want to see something, Excel sheets and a very specific dashboard. So I think understanding their method of working is very important, and spending some time on that, I think, is quite important. And then being aligned in terms of where you want to take the business from there. I think that's also important. As a founder, obviously, you want to build something big and impactful. That's often your motivation. So I think that's something you have to think through, and what you want to do about that. That's important. So the size of the opportunity with the buyer, I think, becomes quite important. Like if that's not there, I think it's better to be honest with the buyer and say, look, this is it for me, and I can't come with the business, right? So I think, and that will change the valuation. Obviously, oftentimes they want you with the business. So I think that's important, and it's important that you provide that transition for them, because they've never run the company before either. So providing that sort of bridge between how you were running it and later, so that they can run it in an effective way, is also very important. Which is why I think you have to budget in 1 to 2 years of transition time, regardless of how you do the transaction. I honestly think even if you got a cash out and you were no longer sort of needed, I think you should spend time just to ensure that they get a product they can use. I mean, you're also, ultimately, that's a responsibility you have as a
That's
trustworthy
very wise.
person in the business community.
So now almost all of you are out of the gardening period, or whatever you call it. What's the next gig? Is it same founders, same?
Yeah, for me personally, we are obviously growing the Loco business in many different countries. We're actually hard at work in improving the product. So that's where I've been spending my time.
It's Brazil based?
We have different countries on the roadmap right now. Brazil is one of them that we're actively thinking through. So we've improved the product significantly. One of the things that when you have a fast-growing product is it's like tying your shoelaces while you're running. So over time, you don't get the time to actually build a lot of things. So I think that's one of the comforts or advantages of having this sort of setup, is that you can actually spend more time on the product and things you want to do. So that's something that's a big advantage of an acquisition, which we didn't discuss, is that you don't have to be actively running around raising money, because somebody else is taken care. Either they have it on their balance sheet or they're going to do it for you. So I think that is a big advantage. If you're product focused, that can be a big relief, that you don't have to keep going and talking to investors day in, day out. There's a different sort of responsibility in terms of reporting, like I mentioned, but that can be a big advantage of not having to run around that stuff anymore, and really focusing on sort of what you thought was the fun element, which is building product, getting in front of users, those sort of things. So yeah, we are all of us are actually in that. So me, Ashwin, Aditi, all of us are in that period where we're just thinking on how to grow the businesses that we have new investors in, and grow them to a significant level for them to be more meaningful in that universe.
Questions?
So we'll stick to very few questions and we'll keep the answers short because we're running over time. But I think we have a very intent audience.
Hi. Sorry. Hi. Thank you so much for your sharing the insights. It's really amazing. And could you share a little bit more in terms of your personal negotiation tactics and tips during those strategic acquisition time?
I mean, this is pretty cliche because my co-founders laugh at me when I say this. So I took, in fact, it was mentioned in my wedding speech also by some of my friends. There's a class I took in business school, and I think one of the most valuable ones, which was a negotiation class. And I actually, my wallet's in my car. I actually have, there's a card they gave us. I still have it with me. And that just gives you a framework to approach the negotiation, right? So versus of thinking of, because the problem with any negotiation, and this could be a dispute with your neighbor, or it could be something of that sort of level, or this could be a multi-billion-dollar deal. There are people on the other end. So I think understanding incentives, understanding what you want also is also really important, and writing it down I think is very important. So I think I use that framework. It's called Getting More by Stuart Diamond, who was a professor. He still is a professor at Wharton. And that just gives you different frameworks to kind of look at a certain situation. So what are their incentives? Where can you create value together? Which is often forgotten in the grabbing of value process. You're like not thinking about why you were there in the first place, which is to create value together. So where can this go? I think that vision is important. For me, in any negotiation, I try and do that and see how can I help the other person? Because if I can approach the conversation from that mindset, then the other person can see that I'm actually on their side versus this adversarial conversation. And I think listing your problems for them to clearly see is important. Don't hide those. If you feel that, let's say I'm exiting a business, but I need to be incentivized in a certain way, I think it's important to put them out and say, I'm feeling demotivated because of A, B, C reasons, or like these are problems I faced in my business. Can you solve these for me? Because they may give you a solution and you may knock off, whether it's your own personal salary or whether it's, on the investment side, you could knock off certain requirements, right? So I think being open to that is important. Then understanding things from their perspective. I think, like I mentioned this multiple times, is really important. And you can use your board very well there, or you can use your friends and folks in the business community, advisors, mentors there very well, because they have been those people, right? So, and there I would ask, A, what value can you create for them? B is, what are the, like inversion, as Charlie Munger would say, which is, what are the active stupidities to run away from? So that's why, like, what would scare them away? Like literally, how could you kill the deal? So knowing that is very important as well. So that you're not doing those things, right? There could be cultural things, simple things like, I have a terrible habit of being late, but some people take that very personally. Like I don't take it personally, but some people don't like it when you're in your phone in a meeting. Like they could take that personally. Right? Now, these are small things I'm telling you from meetings I've seen. Whereas, if you're focused in the meeting, you're dressed in a certain way. Some people don't like it when you come dressed in a suit. Some people want you to be dressed casually. Some people want you to be dressed in a suit, as the US president told us recently. So it depends on the culture. I think you have to really adapt yourself to that culture. So these are simple things you can prepare ahead of time. So you don't go into the meeting without making some obvious errors. Understanding the incentives, where can this go? And taking the conversation back to that. And what are the big risk factors for them? Because remember, they know nothing about your business either. So how do you build that comfort for them is very important. And I think very few people think about that part of the equation as well, is that the other person, because you know about the business, you're spending your every breathing second thinking about it for sure if you're an entrepreneur. They are spending, especially in larger companies, they may spend 10 minutes in an investment committee, they just heard a top line, they like it, they feel it's strategically okay, there's a team that worked on it, that vetted it. So understanding those things are important. So I think my aim is to prepare. And my personal negotiation style is to think of the right playbook to bring to the table when needed. And by my temperament, I'm not a very, I don't get worked up easily. So, I think that this too shall pass is a good thing to think about in the meeting. Don't lose your cool. Take it easy. You need more time, you can ask for time. So I think those kind of things, personal regulation is very important. Other than that, prepare. And that preparation will help you a lot.
Hi, Anirudh. My question is, like, we know that we are building to get acquired. We're in the AI foundational model field. And we have, option one group, which is the OpenAI, Google's that we want to be acquired by. And then there are tied to, group B as well. How early is it too early to start these conversations with them? And can these conversations with group A and group B happen parallelly?
Our business is quite different, and if you're a little bit more clear.
Yeah, so what we are building is a universal semantic middleware layer that you can integrate with the current AI models, and that will enhance their understanding of languages and cultures across the world, irrespective of whatever language it's trained on.
Awesome. That sounds like a cool project. I think it's never too early. You don't have to tell them that I want to get acquired, but because you are probably not ready to get acquired. But it's important to see how they think, right? So, for example, OpenAI. I'm just taking an example because I don't know them personally.
You're speaking to them recently.
Yeah, but I don't know them personally. So, who's leading the deals? Is Sam going to lead the deal? Is there a corporate dev person? Because that person's your internal champion. That person has to understand your business well, right? So I think, do they use bankers? They don't use bankers. What do they like? What's that negotiation style is important. Strategically, are they acquisitive? Are they not acquisitive? Like Apple, if you see historically, very few acquisitions. Google has done many more, right? And Google has a proper corp dev team, right? So I think understanding that is important. So having chats with them is never a bad idea. Even just explaining your business, getting coffee with them could be a simple thing like that. You will get enough information to have an understanding of are they even in the market, not in the market, and that can unlock. Often they may not be looking to acquire someone, but once they hear about what you're doing, they may make an acquisition just to, be there because that's a call option for them for the future, right? A lot of times you'll see these guys invest early because they know that ultimately they can be the acquirer. Then they'll come back because they can control the price at that point. But that's fine for you. I mean, I think, you don't have to worry about that end stage. Getting someone like that early on is also great equity builder for you because your mortality risk decreases. So I think never too early. You can have a chat with them and they may tell you it's too early. We will look at you when you are at this stage in your product. I mean, I'm not even going to revenue, but like product metrics are like this or like these many users. So then like, okay, at that point I can get there. And so let's say a year before that, then you can rekindle the conversation. And good thing is that they may have discussed the same way you will discuss. You will go back and discuss with them as well.
I'm going to keep it as last two questions.
Hi, good morning. I'm not so sure if the playbook for F&B is very similar to tech. And so my question is, you've mentioned several times to have a banker who will transact for you or maybe represent you. Is having a banker one of the best ways, or should we have somebody to represent us because we are scaling up? Like I said, I'm in the food manufacturing business. And also, so that's my first question, is having a banker that necessary? Or is there another, I don't know, somebody who can represent for us, like partially exiting the business? And the second question is, you said that you'll never know who really is interested in your business. So what would you suggest? How should we start, announcing, like maybe subtly or discreetly without signaling to the market? Because at least in the F&B business, if people hear, they're exiting, maybe there's something wrong or they're selling. So is there a way to do it subtly but effectively? Thank you.
Sure.
Yeah.
It's about the channel. So you mentioned about bank and could be FAA, could be all kinds of channels. Can you just share your experience of using the channels and also different from maybe you consider US and UK as well, and because not just Dubai happen to be Westwood in free zone. So can you share those experience with how to get the most effective channel strategy?
I think these are all very good questions. I prefer having a representative. Now, it may not be Goldman Sachs. It could be a banker or like just even someone who's starting out is okay. The key thing is what your aim is, right? So even when you're choosing your advisor, are they an industry specialist? Because industry specialists may get you the right sort of folks. Other times you might want to go wider, and so someone like a Goldman or JP Morgan may be better because they are obviously have wider reach and they have other industry groups. But I like having someone in the middle because a lot of times buyers will not tell you the unpleasant truth. They'll just tell you the comforting lie, we like your asset, but they're not transacting, right? Like finally, like just like in poker, I always say, don't worry about what people are saying, see what they're doing, right? So are people betting? If you like my asset so much, where's the term sheet, right? So I think that having a middle person is helpful in a sale because they'll tell you the real price, or like they'll get a sense for these are the risks that the buyer is seeing and how do we then provide comfort, because sometimes they may be worried about something which is not a big problem at all. They think it's a big problem, but you know the fix, right? So just a conversation can help, right? And especially if you're working in developing markets, they may be worried about things that are not really a big problem, right? Because they've read something on the internet or whatever, right? I'm just telling you from personal experience, this can happen. People are like, someone told me I never invested in India. Apparently you lose more in FX than you do in the investment, right? And they had an experience where the bank kept returning the money. I'm just like, this is like a very simple, like sounds unbelievable, but we got them as an investor, and they invest in India widely today because we then introduced them to the right lawyers and their structure was set up, right? So my point is that have a banker in the middle is helpful. Early stages, you don't need a banker because it's too early. Like if you're doing like where he's speaking to VCs and all, it's better to speak directly. There, you don't need a banker. But if you're in an exit, partial exit, you should ideally get a banker. And you will look at, first see whether personally you think they're ethical and the right people, because I think everything around you is built by people. So having the right people with you, credible people, is important. See their incentive, like, it's on paper, it's great to have some, UBS or Goldman Sachs or whatever. I don't know what the league tables are like these days, but they may not be good in your industry. You may be too small for them, right? So you'll never get the right attention and it'll not work well. On the other hand, it could be a young up and coming person in those orgs and they can really make a big difference for you because they have the organizational background, but they're willing to do your deal because that's their sort of ticket to doing something bigger. So I think understanding their incentive is important. We've used, for example, Loco, we've used Areem. They're a very well-known gaming bank based out of London. We've had amazing experience with them. We've tried other folks before and they've not been as good. On Pocket Aces, we use JM Financial, which is a well-known, a much larger bank from an Indian context, right? So you put them in the same league table as, these Goldmans of the world. There I had tried 2 other bulge bracket firms before, and I didn't feel they were giving us the right coverage. So I think you have to figure out what the right usually it's a person, so the partner or the person that you're working with. So work that out. Fees important, but I think good bankers don't care about that much, is what I've seen. They will see that, okay, this is maybe your first business. You could be doing three times you could do the same business, or it's another deal that strategically is important for them. So I think those things are important. So selecting their advisor is important, but I would definitely have an advisor. And then to your question is more around coverage in different countries, or what was the exact? Channel strategy. Yeah, I think the fee structure, if you have a board or just now with ChatGPT, you can just get the fee structure for different deal sizes. So you'll have an understanding of what the advisor should be making and asking. I think anyone asking for egregious amounts, you should just cut them right there. Like, they're not the right advisor. If they're looking to just fleece you, I mean, there's the wrong advisory model in my view. The good advisors, usually you'll be negotiating for basis points, right? So that's fine. But more importantly, it's like, can they actually get the deal done? And how quickly can they get it done? Are they thoughtful about your business? Those kind of things would be important. In terms of channel strategy, like I said, I keep an open mind. Like I have an open LinkedIn. I have never closed my LinkedIn. So I would not even be, maybe this is counterintuitive, but I won't even worry about messaging someone and saying, are you open to having a discussion? I think it's fine. I think people are too worried that, oh, like what will happen to my price? And the industry will find out and so on. Like there's too many things you're building in your mind which are not going to happen. What's going to be much worse is when you have no options. And that can happen, and then that's a very scary place to be. When you're suddenly up against it and there's literally no source of capital available, you're much better off, trying different options and then being thoughtful about which one you choose. So yeah, I wouldn't, you put it on LinkedIn or whatever that, hey, I'm for sale or whatever, right? That's never going to be the case. But I don't think anyone ever does that. But if she feels that Anthropic is the right partner, I think they should just cold call also. It's no problem. That's saying, hey, we're looking at strategic options. And I mean, I bought 2 of the 3 companies I bought came like that. They wrote to me. And I didn't think less of them or think that, oh, now I can really negotiate this price down. And that was not my first thought at all. My first thought is there a good fit for me? Are these the right people? What will they add to our company? Then we'll go to price. And yeah, for me, price is a very easy thing. Like it could be too expensive and then you're just not even, you're out, right? So that's like a later stage conversation. So my channel strategy would be go to advisors. If there are companies you already know could be interesting, reach out to them or have someone reach out to them and see where they are. They could be actively in the market, they could be completely off. And then yeah, if you have a middle person like a broker or a banker or someone like that, they often know who's in the market because they're representing or other folks in the market are representing them. And that's where you unearth these sort of unusual folks who are maybe trying to shift industries, right? So it could be someone changing strategy. That's where you can unearth them. Or you have industry specialists where they know for sure that they can place you. An industry specialist is usually better because they know where everyone's placed and they can do an amazing job of reducing the time burden on you. So instead of you going to 20 buyers and most of them are not interested, they put you in front of the right people and suddenly you will feel that you're playing professor less and having a more strategic discussion on what you can do together. So that can be helpful.
Again,
I'm
on
going to close.
pricing of advisors, my 2 cents is that the larger ones, typically if the deal is large enough, the larger ones, the pricing is always within reason. The minute you go to the lower ones, and if you cannot afford the bigger ones, you will find varying prices, and they will all justify why they can sell the business for you, and they'll go all out to prove that. So you have to be careful of that. There are maybe 3 dozen advisors, small ones in DIFC now, maybe more. Yeah.